What are like the most key moments and lessons about money and wealth being in the industry for so long?
As an investor, it pays to take a longer term view. I think when you're young, you've got decades ahead of you, which means you're able to recover from any setback, really. But when you're young, you don't know that and you don't think like that because it's like you're seeing things for the first time. When you've been doing it for nearly 4 decades, you're more confident about taking long-term views and acting on long-term positions and being patient than you are when you're younger.
Do you think that politics is influencing the markets more than it's used to?
You can't get around the fact that governments have a big impact. You've gone from a fairly stable, peaceful world to one that's less stable, less peaceful. Change creates opportunity.
How should long-term investors be thinking about AI?
You're not defined by where you come from.
Yeah.
And I think that's a big message that I always want to tell people. Like
you have to be able to be uncomfortable.
Yeah.
Like be comfortable with being uncomfortable.
When you grow up in ends, you don't realize it when you're confident, but you have an audacity to do things that ordinarily most people wouldn't be willing to do.
Welcome back to another episode of the podcast. I'm your host, Atto. We have a special guest in the building. We have Mike Coop, who's the Chief Investment Officer for Morningstar Investment Management in Europe, the Middle East and Africa. With over 27 years of experience in financial services, he leads Morningstar's investment team across the region and is responsible for delivering world-class portfolio solutions to investors. Before taking on his current role, Mike held senior position at Prudential, AXA Investment Managers, and Ibbotson Associates, and has deep expertise in multi-asset strategy, equity markets, and global asset allocation. Mike, how are you doing today?
I'm very well, Atto, and as sad as I am to say, actually, it's 37 years.
Is it 37 years? Okay.
Terrifying.
I mean, okay, we're gonna add 10 years on top. That's amazing. So obviously, I described a little bit about you, but for those who may not be familiar with you, can you share a bit about your background and what inspired you to get into investment management?
Sure, Atto, I'd love to. So I grew up mainly in New Zealand, and this was at a time when investing wasn't really a big deal. No one really knew much about it. So I just happened to have a choice at school. I had the option of 2 subjects I could choose from: physics, which I'm terrible at, or something else. And the something else happened to be economics. So purely by chance, I ended up doing economics and found I quite enjoyed it. So that led me on to thinking about what I might want to do after school, which led me on to doing an economics degree. And really through that, I ended up stumbling into the investment industry.
Okay, wow. So it's by accident, the fact that you decided to choose economics. And why investment? Out of everything, there's so many like different areas that you could have gone down.
I think at that point in time, it was open, all the countries around the world were deregulating their market. So things which hadn't really been open were suddenly open, and it's a very exciting time to be part of that. But a lot of life is just about chance and luck, and so I happened to have an opportunity to get involved with an investment firm that did research on fund managers. This is back in the 1980s.
Wow.
And so that just, and I worked with someone who was a very good investor, and I learned a lot from that person. But really, that wasn't down to anything I'd done. It was really just a serendipitous.
Okay. Huh. I like that. And I like the fact that you said that it's due to chance, because a lot of life is that, stumbling on things by luck, but also taking the chance an opportunity that you have. So you've, as I mentioned, you've gone up the ranks to Chief Investment Officer. Looking back, on your journey, what was like the kind of pivotal moments or decisions that you kind of did that led you to that?
I can't say it was really a deliberate thing.
Okay.
I didn't set out going, I'm going to be a CIO. It was just a natural curiosity to try and figure out different types of investments and different investment strategies, and to keep on exploring and challenging yourself with your understanding. So that was really how it came to be that I just ended up building these different levels of experience and expertise that equipped me to take on this role, rather than bring something that I set out to do at the start. So I think for a lot of people, life is a bit like that. You follow your strengths, your interests, your passions. You give it your best shot. You try and work with people who can give you good feedback, who will support you. And then, you have many different career paths, and it just so happened that this is where I ended up.
Yeah. I like the fact that you said support, because a lot of that's quite underrated for a lot of people in their career. They don't really leverage the whole, getting a sponsor or getting a mentor. How did that happen for you? Was that by accident, or was it something that you kind of deliberately?
Yeah, it was one of those situations where it's a byproduct of the organizations you work for. So when you're young, it's pretty hard to really know enough about a company to know what its culture's like or what the people are like. But once you've been working for a firm, it becomes quite clear whether or not they care about their staff, whether they're trying to actively support you in your development, whether they're taking time to help mentor and train you. So you can certainly see whether that's the case. And I think that's one of the most important things when people are setting out on their career journey, whatever it is that you're doing. And if you're not getting that, then you need to think about, is this the right employer for me?
Yeah. I like that. I really appreciate you saying that, because it's a lesson that I think that people can probably apply to their journey. Maybe some people are feeling like, oh, actually, I'm not getting the traction, or maybe I'm not getting the support and development that I need. So therefore, maybe I should think about moving. So we talked about you having 37 years in, financial services. What are like the most key moments, and I guess even aha moments and lessons that you've kind of learned about money and wealth being in the industry for so long?
Your best teacher is usually your mistakes, which means that the more you do, the earlier you do it, the more you'll learn. So in my case, I started my investing career in 1987. Now, in 1987, there was a 20% fall in the US stock market in one day.
Wow.
And after that, people were talking about, is this a repeat of the 1929 Wall Street crash? Will there be a global recession? So it was fascinating, like what is going on? And so you got to observe how other investors responded to that and what they did. And so that started to give you a sense of the possible ways to respond. And as you go through your career, you are able to recall the things that have happened to you, and that builds out your knowledge. And you're also able to read about history and how we make decisions, how we programmed to not be very good actually at making investment decisions. And as you become more aware of these things through your own mistakes, that's often a turning point. So that was one episode. Another episode was in 1998. There was the Russian government defaulted on its government debt, and there was a huge meltdown in markets. There was a giant hedge fund which used tons of leverage called LTCM. The long and short of all that was it was another massive shock.
Yeah.
And as you go through those journeys, you observe how afterwards, not while you're doing it, unfortunately, afterwards you observe how you behaved. And so you could tell that you were when things are bad, your natural inclination is to assume that they'll carry on being bad. And it's really hard to think about any positive situations in the same way that in a boom. And so in 1999, we had the peak of the boom in technology and innovation last time around. And it had been going on for so long, to such a degree that people just got carried away and couldn't think of any other situation. So those experiencing and living through those sorts of environments makes you very humble about your ability to forecast things, makes you more aware of the fact that how you see the world and how you behave plays a really important role in your success as an investor.
Yeah. As an investor, I think that's such an important lesson for most people because, and we're going to talk a bit about it recently, obviously, the markets they're volatile, up and down. And it's happened a few times actually through the last years. But I want to know from you, right? The more you experience that, do you feel like you got better at managing and dealing with it, or did it just kind of feel all the same to you every time you kind of got to, oh, okay, another stock market crash here?
Yeah, there's kind of an irony in the whole thing. When you're young, you've got decades ahead of you, which means you're able to recover from any setback, really, because you've got many decades, many years of income you're going to earn, and any setback you happen to be affected by early on in your career, you will recover from. So it's not really very consequential. But when you're young, you don't know that and you don't think like that because it's like you're seeing things for the first time. And you only really remember the things that you personally lived through. And because your lived experience is very short, you don't have much of a barometer to measure it against. When you've been doing it for nearly 4 decades, you start to see the things that are regular features of how the economy works, regular features of how the markets work. And oddly enough, even though you're further in your life and further in your investing career, you're more confident about taking long-term views and acting on long-term positions and being patient than you are when you're younger. So to your point, really, Atto, I've lived through and seen many different types of crises, and I've seen how the economy behaves and how investors behave. And the point about investing is it's often an industry where a lot of people leave the industry sort of the middle of their careers or even later in their careers. So most investors don't have a very long collective memory. So yes, being able to think long-term is very helpful for people who are listening to this and wondering about investment. Trying to think long-term is helpful, and being prepared to be patient is helpful.
Yeah. Okay. Thank you, because it's all interesting. I was thinking as you were saying that, it's such a inverse, right? Like you say, younger, not maybe as patient, older, patient. Gosh, it's like that thing where when you do discover investing, it's like you always wish that you could have done it sooner. That's always the thing. So I do want to talk about the basics of investing to just set the scene for people, especially if they, it's something that is new to them. So for someone new to investing, what's the simplest way to understand how investing in the stock market can help them build wealth over time?
Sure, and that is a really great point. So it's about building wealth over time and thinking about your life. And investing it's a vehicle to get you to where you want to go in terms of your lifestyle, how you want to live your life, what's important to you, your values. Those are the things you have to get clear. From that, you're setting financial goals that reflect these lifestyle aspirations you have. I want to own an apartment. I want to go traveling on a holiday. I want to retire when I'm 45, whatever it is. So you really, that's the starting point. And investing is just a way for you to achieve those lifestyle objectives. It's not a means to an end in itself. It's not an end. It's really a means to an end. And so getting that clear helps. When it comes to investing, what you're really trying to do is you're trying to think of these goals you're trying to achieve, and then you're picking different asset classes to help you achieve those goals. And the main asset classes are shares, property, fixed income and cash, and shares. And each of those, the same drivers of return apply. And those drivers are quite simple. Morningstar, through its research team, has published empirical research breaking down what are the sources of return. Number one, it's income. So some assets will pay you an income, like the bank pays you interest. Companies might pay a dividend. Or if you own a property, you get rent. So you get the income component. And then you've got what we call the capital growth. So the capital growth is just the increase in the price of the asset over the period that you own it. And because the whole point of saving is to be able to spend more in the future than you can today, then you need to beat the rate of inflation in terms of the growth of your investments.
Yeah.
So you want to look at the growth really being the change in the price of the asset, and what you're aiming for is it to be well above the rate of inflation. So if inflation is 2% per annum, you want the price of your asset to be up by more than 2% per annum.
Yeah.
If it's going up by less than that, then you're actually falling behind, and you might as well spend more money now and not save.
Yeah.
So when we break it down, it's income, it's capital growth. The other element, of course, is the costs. That's the bit that gets taken off your return that someone else gets to keep. So that is actually more important than people might think, because it can quickly add up. And the main types of costs are really to do with when you're buying and selling the asset. There's usually some sort of cost that you have to pay to the people involved, or there's a reduction in the price that you get compared to the price that you paid. And then there's usually some sort of cost to managing and owning an asset. So either you're paying someone else to do that, or perhaps you're doing that yourself. If you have a property and you might need to go and repair the property from time to time, for example. Also, if you borrow money to be able to buy the property, then one of those costs is the interest you have to pay on your debt. So those costs are important and shouldn't be ignored. But let's go back to the essence of it. It's the income. It's the capital growth. So the income probably sounds quite straightforward. Companies pay dividends. If you've got a property investment, then you'll have a lease. The lease will set out a requirement for the tenant to pay you a certain amount of money, possibly going up each year, and so on. And then the bank will pay you interest, and fixed income, effectively, it's a bit like a bank account, except that you're lending money to not the bank, but some other organization. It could be the UK government, it could be a company, and in return, they're going to pay you some interest and then your money back at the end. So that thing, I think, is something that's probably finished off. What drives growth is maybe less clear. In other words, what drives the increase in price of an asset over time? So the increase in price of an asset over time is really usually driven by one or two things. So with any asset, it's either, in the case of shares, you're taking a stake in a business. That business is making money, hopefully, and over time, the amount of money it makes goes up and up and up. And it's the rate at which the business is growing its profits, which will ultimately drive the increase in the share price. This is over the very long term. We're talking 10 plus years. In shorter periods of time, there's another factor which can impact the return. And that is, in effect, how popular the investment is and how the popularity changes. So it's a bit like fashion. Some things become very fashionable, and just the same way the clothes have different styles, and things come in and out. And people, the same applies to the world of investing. People become very fixated on one particular type of theme, perhaps, and they are very enthusiastic about that. At the moment, that's AI. We'll come back to that later on. But in the past, it's been things like emerging markets or commodities. So when that happens, people who get very enthusiastic form a very optimistic view about the future and are prepared to pay a lot of money to own the asset. But then that can swing like a pendulum from extreme optimism to extreme pessimism. So when you get these mood swings, you can suddenly find that the price goes up or down a lot in a way that's not really driven by the underlying income or profit growth in the case of shares, or rental growth in the case of property. It's driven by these sentiments. And in the short term, that's much more significant. And as a consequence, there can be a randomness to how randomness to the returns in the short term. But in the long run, this fundamental of, okay, whatever this asset is that you bought, it has an income stream is growing, which could be the profits and dividends, or could be the rents. That will usually be the driver in the long run of the capital return that you get. So for assets that don't have an income stream or don't have a clear value they're adding, that's when it becomes a bit more like a lottery. You don't really know what's going to happen. It could wildly swing either way. And so they don't tend to be, so that tends to become more like a speculative investment, where it can be a bit like buying a lottery ticket, or putting money on horse racing, or going to a casino, where it's just luck. And in most cases, the odds are against you, and quite often also quite a short-term endeavor. So that is a difference between speculation and investment. And so for investments, what drives return is that growth and that income minus the costs.
I love your explanation, and I hope it was very clear for the watchers and listeners. And actually, I'll just add to what you're saying, because I really liked what you were saying. So just to reiterate, right? So when you're investing in an asset, and we're going to focus mostly on the stock market, right? So when you're investing in a share of a company, what you're saying is that in the short term, so we're thinking from days to months, maybe even a year, actually, the price of the asset, right, can go up or down a lot based on how popular it is, which what people call that, they refer to that as sentiment, which is very true. Like you said, AI is very popular. That's the theme. Everybody's talking AI. AI will do this, AI will do that. In a few years, it could be something else. I'm trying to remember what it was before. It was green energy before, actually.
That's
just
right.
very shortly.
Yes.
That's gone. So around COVID, it was green energy. Tesla was doing well. Other green energy stocks and ETFs. Now that's kind of fallen. Now it's like AI. So okay, that I'm understood on that. That makes sense. But then you're saying actually, really, on long term, in terms of for a company to justify like the value of the company, it needs to be producing like revenue and actually like growing its revenue every year and producing profits, and that's all actually really determine like the real price, not this
That's
short
right. So,
term
that's a really good way to put it.
Yeah.
So, there is one other component that can influence return, which is those swings that I mentioned. And when the price of an asset becomes very disconnected from any realistic assessment of its value. So, a simple metric people use in the stock market is the ratio of the price of the share divided by the earnings of the business per share. So this PE ratio, and so people, let's say for example that on average companies have a PE or price earnings ratio of between 10 and 20, and all of a sudden you've got a company where the price earnings ratio is 50. Or is 3. So imagine a situation where it's like a piece of elastic. You can pull it very far away from what's reasonable, but in the long run, it's highly unlikely to stay that far away.
Yeah.
If its fundamentals justify a PE ratio of between 10 and 20. So it tends to be brought back. So stock markets go through those episodes where they occasionally get very disconnected from the reality of what's likely to happen. And so occasionally you get this component, which is a valuation component of returns. Think of it as like a mispricing.
Yeah.
So markets which become ridiculously cheap because everyone decides they don't like them anymore and they're very pessimistic because at a point in time things are bad, but over time things won't always be bad. And when they improve, people change their mind. Oh, okay, it's not as bad as I thought it was. I'll pay more to own that asset. So in the same way that when everything's fantastic, everyone's going, wow, it's amazing. These companies are growing at incredibly high growth rates. I'm prepared to pay a lot more money to own that business. But if that's not sustainable, then eventually, the growth rates will drop and people will reassess what's likely to happen in the future, and they won't be prepared to pay so much to own that business.
Okay. That's clear. I know what it feels like when your business expenses keep rising, but your business income doesn't. From big ticket costs like staff wages, tax bills, and rent, to the smaller stuff that adds up fast. Card fees, event fees, software subscriptions, delivery charges, even your phone and internet bills. Running a business in 2025 is expensive, and it's not getting cheaper. Yet, so many of us leave thousands sitting idle in a standard business account, earning nothing, when that money could be growing effortlessly through business savings. That's like leaving your stockroom full, but never putting anything on the shelves. You got the goods, but you're not letting them work for you. So isn't it time your business funds worked a little harder for you? That's why I use Tide's Instant Save account. You can earn up to 4.22% AER Variable on your business savings passively, FSCS protection up to £85,000, and you can open an account with just £1. This very minute, Tide is offering a £100 bonus for new members from our community who open and fund a Tide Instant Saver with £5,000 in the first 30 days. Just use the code SAVVYWALLET, plus for the first 6 months, you can earn up to 4.22% AER Variable on your business savings. It only takes 3 steps to get started. Tap the link in the episode description, enter the code SAVVYWALLET, and let your money start earning while you work. New Tab members receive up to 4.22% AER Variable. Interest rates are tiered with a top rate for balances over £1 million. New Tab members get these rates free for 6 months. After that, your Tide plans rates apply. For the full offer Ts&Cs, visit tide.co/savings. Rate correct as of the 8th of May. 2025. And talking about discount, right? I wanted to know from you, right? So based on Morningstar's analysis, which global market or sectors are currently undervalued or overlooked, and what key indicators are signaling these opportunities?
So when we look at identifying what's good and bad in markets, we have to first of all do our homework. So we've got to be able to look out and say, what is likely to happen to this business, this industry? And we do that over a 10-year period to get a sense, because at any point in time, you might find that you're in a boom time or a bust time, And so you really need to get a sense of, over a full economic cycle, what could happen to this business? How much will it be able to earn? What are the risks associated with that? And when you add it all up, you then go, well, what is a fair price to pay? So just like anything else, when you're trying to work out how much should I pay, at the moment I'm trying to choose a car. So I'm working out, well, what's a fair price to pay? What features do I want to have? So you've got to look into the future when it comes to investing and ask that same sort of question. So we do that work, and we from that research, and we've got 400 people doing various types of research at Morningstar to cover every possible type of investment, a way of accessing the investment. And so that provides an anchor. So my sense of fair value is I'm going to pay, a certain price to own an asset. And what I'm then doing really is I'm comparing the price of the asset today with what I think their fair value should be. So if the price today is way below what I think their fair value should be, then I can make an educated guess about what kind of return I might get. I can say, well, what happens if the price of that asset reverts to my fair value over some time period? So that's what we do. We basically we create a fair value, we do our research, assess the fair value, and then estimate, well, what will the return be if the price went from where it is today to our assessment of fair value? So when we go through that exercise, what we find is, generally speaking, emerging markets look like they offer better returns because the prices today are in some cases below our assessment of fair value. So Brazil is an example of that, Brazilian equities. There's other pockets that we see in the US that have been ignored. Smaller companies have been ignored as everyone's clambered after the dominant IT global businesses. So those two areas, the UK isn't cheap, but it's still reasonable value compared to many other markets. So those are three examples of markets where we see more value on offer. We think that there's been a bit of a sell-off in healthcare, and that also starting to look more interesting, and energy is also sold off as well. So those are some of the things that we're seeing from the research at the moment.
Okay. Let me hone in on the UK, because we're in the UK and I think it's always fair to talk about them. What makes them look undervalued to you? Yeah, from your opinion. And not only that, on the flip side, if it is does undervalue always mean a good deal? Do you know what I mean? Because sometimes it doesn't, right?
Well, so for the UK, you've got to go back in time a little bit to see how we got to where we are today. So the UK went through a period after the Brexit referendum vote in 2016 where global investors thought, I don't know what's going to happen. And the whole political process was pretty chaotic in terms of how it was handled. So for many global investors, they took the view that it's uninvestable because we have no idea what's going to happen next. So the UK kind of fell off the radar screen. Then we had a political chaos for a few years as well. And the UK also became viewed as perhaps it's not a very well-run country. So while that was happening, people were really ignoring the UK, and it at the same time had a mix of industries in the stock market which were out of favor, weren't fashionable. So those, it didn't have any big IT companies, for example. Mm-hmm. It had oil and gas companies, it had commodity companies, it had banks. It did have some global healthcare companies, pharmaceutical companies. It had some consumer goods companies that were also world brands. So it has this strange collection of businesses which are, it's really like you're buying the world. So you're buying quite a few global industries because most of the big companies are actual global companies. They're not really anything much to do with the UK. Yeah. So you had this global basket of businesses. So when you compare those industries and what you'd normally pay to own them globally, and then you look at what you're paying to own them here, there was a discount because people, for the reasons I mentioned, had ignored the UK, weren't sure what was going to happen.
Right, okay.
And so the money had gone elsewhere. So that can go on for quite a long time, but eventually a gap opens up and investors are rational. And so what's happened in the last few years is suddenly those factors that were counting against the UK are now more in favour of the UK. So it has a bit more political stability than it had before, and it has more stability than other countries had before. As well as that, it has not been as heavily impacted in the tariff changes as other countries have. And all of those things together with the valuations on offer mean that it's attractive. And you see that because the businesses themselves are buying back their own shares with their excess capital. And you see that because private equity firms are buying UK businesses and continue to buy UK businesses. And the final thing I'll mention on the UK is there was a big headwind for many years, which had come from the fact that 25, 30 years ago, UK pension funds, most of their equities were UK equities. And over the last 20 years, they've reduced the amount they have in equities as the people in those pension schemes have got older. And at the same time, within equities, they've also dropped the amount of UK as a share of those equities dramatically.
Yeah.
So you've had this constant selling down. You've now got to a point where it's small enough for that not to be a factor anymore. So it's a bit like, someone's been pushing down something and all of a sudden they stop pushing down on something. Okay. So all of those reasons mean that the UK is a bit of a Cinderella. And with these things, again, you as an investor, it pays to take a longer term view. And so while something might be undervalued for a while, eventually that value gets recognized. The issue with valuation is when you've not properly taken into account the fact that things are getting a lot worse and actually the asset is not as valuable as you thought it was. And so you get it. So I think the point that you were hinting at was really, look, can you be sure about these valuations? And so they've been heavily stress tested a whole variety of different situations, and there's a very sound basis for them. Okay.
Interesting. Okay. Cool. Because UK is, I understand what you're saying. UK has been, now that we look back on it, it has been a bit turbulent actually since like you say, Brexit, politics and stuff like that. And you're right, investors don't like, just with the tariffs, any kind of shakiness is just like, yeah, we're out of here. Which to me is like, it's so interesting because investing in such an old age thing, and you think there would be a bit more stability when these kind of big, like, I wouldn't even call a tariff thing a crisis. I would just say it's a situation, but these kind of instability just creates panic across the board. I wanted to talk a bit about Brazil because we've never really spoken about emerging markets, right? What's so interesting about Brazil? Why does that come under the undervaluation? What you've kind of seen there that says, okay, yeah, this place can potentially provide good returns.
Yeah, those things I mentioned before, when really you've got the price that you should pay to own an asset given its outlook, and given the risks, so the growth and the risks, if you like. So in this case, people have assumed the worst. And as it happened, Brazil was not really meaningfully impacted by the tariffs. The concern was really around the change of government that happened there, with a guy called Lula who came in, who was previously around the place and worries about the rule of law and corruption. But that hasn't really been proven to be well-founded. And in fact, Brazil has lots of valuable natural resources. So those things have become more valuable, and the governance issues, which are basically a way of saying, is it being properly managed, we think have been overdone. So when we look at it, we see better value than and less risk, and so we think it's undervalued.
Okay.
And it's quite a different type of investment exposure because of what drives that economy, what drives the stock market earnings.
Yeah. And Brazil, being an emergent market, I have to be careful the way I ask risk because I know people see risk as different. Maybe I'll explain what I mean by risk, right? Actually, no, I'm not going to say risk. Brazil is likely the price, like, so if you were to, let's say, for the watchers and listeners, say you were to invest in a Brazilian company, right? It's likely to, the price is likely to go up and down more just because it's not as established as, you know, America, the UK, and, you know, things like that. Do you kind of see that even though it's undervalued, do you expect that to kind of continue if you do invest in like a Brazilian company that, you know, the price could fluctuate just as much even though it's undervalued?
I think as you're thinking about achieving your financial goals and you're using this as a way to generate returns, and your financial goals are with you your whole life. So you've got plenty of time to be able to let this play out.
Yeah. Okay.
It's more a case of saying, look, as part of a diversified portfolio, these look like an interesting opportunity. You've got a margin of safety. When people get pessimistic, they're kind of pricing in a bad case scenario already. So if that bad case scenario happens, well, you know, it's kind of priced in.
Okay.
So whereas if you have very good, you know, only the best scenario, you're wearing your rose tinted glasses, you think the world's going to be fantastic. You pay a lot of money to own something, and then you suddenly find that that's not the case, which is sort of what happened when this Chinese firm DeepSeek announced that it was able to almost replicate a ChatGPT, but much, much cheaper. So I think that's when you have more scope for disappointment, and the disappointment can lead to a pretty sharp move in the price down.
Okay.
So the volatility is just a feature of how markets work. And certain industries, the share prices are more volatile than others because their cash flows can move around a lot more than others.
Yeah.
And then with emerging markets, you also have to think about things like exchange rates. But that's all a case of how much you allocate.
Yeah.
So it's just an example of where people have gotten too pessimistic.
Yeah. Okay. So I guess people, if they do invest in emerging markets, they just definitely have to be mindful that the price of what they're investing in can fluctuate a lot, but just also remember their goals in mind and that they're investing for the long term. Because honestly, like, you know, if somebody could see, like you said, the 20% down, they could see that and it's a panic. I'm selling. This is bad. This is bad news. I've just, you know, invested in
Well,
this.
the thing is, you know, I could say the same about the US.
Yes, true.
And I could say the same previously about the UK.
Yes.
So,
okay.
There are certain features of these countries that make them different, but actually because things are a lot less stable than they used to be everywhere, you know, it shouldn't be assumed that developed markets are less volatile.
Right. Okay. That's a good point. No. Thanks for correcting me on that, because you're right. Actually, given what's been proven over the last few weeks, it's true. I wanted to ask you about China because you mentioned DeepSeek. Is that part of the undervaluation that?
China was a really interesting test case of how you get these swings in popularity. So in 2021, about February 21, everyone was in love with Chinese IT companies. So the market was in our view very overpriced. Everyone loved it. They knew that there was a property crisis. They knew that the things they were investing in the US were not exactly like shares and kind of have quite the same rights. That was all known. But that didn't bother anybody because they were in love with IT companies, and China has some pretty dominant IT companies. Then over the course of the next 12 months, investors became concerned, firstly about whether the way they were getting exposure to Chinese companies in the US was a safe way to get exposure. Then there was the Chinese government had a crackdown on some of the businesses, which in their view was becoming too independent of the Communist Party. And then you had further deterioration in the property crash that happened where there was oversupply. So all those things happened, and investors basically suddenly decided China uninvestable. Yeah, I will not invest in China anymore. China is the world's second or arguably actually the largest economy in the world. It has a very large stock market with many really great companies. So this is not a fringe economy or a fringe market, but people had decided just to abandon it, which drove the price down by about 60% over a 3-year period. So people became exceptionally pessimistic. But you had these brilliant businesses. They didn't need a lot of debt. They were very dominant in their local country, and they weren't exposed to tariffs.
Yeah.
But they've been marked down to really low prices. So for us, we work with our colleagues who cover Chinese companies out in Asia, work with our economists to think about the macro situation. And the more we looked at it, the more clear it was that actually there were some terrific businesses you could pick up at really good prices. And so that's why China's been a really great investment over the last 12 months because people were just overly pessimistic.
Is it still at a good valuation, even though
we
it's
still see it as a good thing to have in portfolios and more attractive than usual? But it certainly investors started to realize that and started to move back in.
Okay. So I had a question for you as I was thinking about it whilst we were speaking, and it would be good to get your observation on this. You've been investing a lot longer than I have. And I don't know, do you think that politics is getting more, is influencing the markets more than it's used to in the past? It's like another factor because we didn't mention it, but as we've been speaking, I've realized actually even a lot of why a lot of these markers have been down. If we talk about the UK, talk about the US, it's all political things happening that are just, even for companies doing well, it's just affecting them.
Yeah, it's always been the case that what governments do matter for investors. So most industries are regulated in some way, shape or form. All companies are taxed. So you can't get around the fact that governments have a big impact. In emerging markets, that impact has been bigger because they've, in some cases where there's been less democratic controls, then the governments are in power for a long time and can have greater influence on how businesses run. So that's the first thing to remember. It's always been there forever. However, there was a period of time when things were more stable for investors. And that period was really from after the end. So probably from about the mid-1990s to the mid-2010s. So that period was relatively stable in terms of governments. Because why? Well, because previously you had the Soviet Union, so you always had this direct conflict between the US and the Soviet Union and all the countries that were aligned to each of them. And you had conflict points. Then really in the sort of mid-2010s, you had Putin's first invasion of Ukraine and you had the expansion of Chinese military power happening. You had Trump come in 2016. So over a period of time, you've gone from a fairly stable, peaceful world to one that's less stable, less peaceful. And because of COVID, governments had to get much more involved in running things. Okay. And that's continued to be the case. So you're absolutely spot on, Atto. Governments are much more active than they were previously in the running of economies. And that's particularly under Trump, and what he wants to do is having much bigger short-term impacts as he it's also to do with the way in which he operates. But in a nutshell, investors need to pay attention to what the politicians are seeking to do.
Yeah. Okay. So although these things are, again, it's just like, I don't want to say noise, but it's kind of like another noise, is another alarm, but it's an alarm maybe that you don't need to be worried about, because if you're investing for 10, 15 years, this thing that's happening now may not be a problem in 10, 15 years. You're going to have new governments, new thinking. It's going to be a different world. But so long as the business that you're investing in is continuing to grow, is continuing to operate, continue to generate revenue, it doesn't matter.
Yeah. So it could change creates opportunities because people overreact. And when they overreact and become too pessimistic, then you can buy something at a good price.
Okay. Amazing. So I wanted to move on to AI. How should long-term investors be thinking about AI? Is it a must-have in a diversified portfolio or an area to approach with caution?
So AI is not something you can kind of directly own, but it is a something which you have access to in two ways. You've got access to the businesses which are seeking to be at the forefront of providing generative artificial intelligence, and those are the ones who've got the most attention. So either the ones that are selling the ingredients to make it, like NVIDIA makes these chips, or businesses like Microsoft and Amazon and Alphabet, which owns Google, and Apple, who are trying to offer that to their clients or consultants who are trying to make money out of it. So there's that first wave. But like all general purpose technologies, so think the invention of electricity, steam engines, the internet, books, the wheel, go back in time. The real impact happens when everybody starts to apply the new technology. So it will be a boost for many companies because it will reduce their costs. It could also create new goods and services in the same way that we didn't have Google 40 years ago, but we have it now. So it's something that you will have exposure to kind of whether you like it or not.
Okay.
Because these businesses who are at the forefront of helping provide it are big parts of stock markets. But when you go through big periods of change, by definition, it means that change, that the pace of change picks up. So you don't know who the winners are going to be. And previous examples show that it's not necessarily the people who were dominant at the start. So people need to be a little bit careful about being overconfident about forecasting the future and recognize that in rapid periods of change, you're likely to be surprised.
Yeah.
So when a theme becomes very fashionable, when everyone's chased that, and when the price of the related company's gone up a lot, you should be worried.
Okay. So,
and it's, it's not, so it's pretty hot area.
Mm.
And if you're late to the party, you can end up just going lemming like over a cliff because you paid too much to invest in something, and when it disappoints, the price can fall a lot. So you need to know what you're doing. Mm-hmm. If you're going to get involved at this late stage. It's very late in the day.
Yeah, it is. It's definitely late, but a lot of people are still talking about it, and just.
So like anything else, you've got to do your homework, which is why investing is about doing the research, committing to doing the research, getting the data, the analytics, the research to try and assess what a reasonable price to pay for something is. And only when you've done that can you work out whether the price today means it's good value or whether it's shockingly overpriced.
Yeah.
Or just fair value.
Yeah. You mentioned the Magnificent Seven, or we mentioned that, right? And they're leading at the moment. They're kind of dominating the returns on the stock market. Does it make sense for investors to start looking beyond them? Because you did say that it's difficult to kind of predict what the future is, but that's dominating now. And I can imagine that a lot of investors are probably looking at those seven and saying, yeah, I think they'll probably still be in the future, but what's kind of...
And I'm sure they will. So Cisco, Microsoft, Apple fell between 50 and 70% in the sell-off that happened between 2000 and 2003. Those are great businesses. They're with us today. But they got pumped up so much before that. They have these heavy falls. So with investing, it's not just about what you think will happen to that business, but it's also how much is priced in.
Yeah. So it's how much is priced in, and just making sure, again, it goes back to the valuation, right? And just making sure that you keep your eyes on it. Okay. All right. Cool. I like that. Is there any I know we talked generally about like undervalued sectors. Does Morningstar look at analysis for potential future areas that are, obviously we talked about AI, but is there like any other areas that you think is going to be, I suppose, a growth area in the future that Morningstar are looking at the moment?
So we're working with industry analysts who spend their careers just focused on analysing and forecasting for individual companies all over the world. So within the domain of listed companies, there's always areas that are growing quickly. Again, the issue isn't about the growth. It's also about what's priced in. So so there's nothing I could tell you today saying, oh, these are because we don't really think, we think of the whole totality of the investment.
Okay. Yeah.
What are the growth prospects? But also, so what's the fair value? The fair value will capture that. So in the same way, I'm going to pay more to own a Rolls Royce than I am going to own a Skoda. I'm going to pay more to own a great business which is fast growing, doesn't need much capital.
Yeah.
What we do as another way of thinking about this is there's a framework that Morningstar uses to ask the question, okay, can this business continue to grow at rates which would be usually very hard to maintain? And there's this concept called a moat, a bit like a medieval king with a castle who wants to protect against being invaded and creates a moat, so a ditch with water in it around the castle to make it hard for others to come and take over the castle. So that analogy for business is doing things that make it hard for competitors. So it could be that you've got a very good brand. Mercedes-Benz is a really good brand when you think about cars, for example. It could be that there's a network effect where everyone goes there because it's like a marketplace. Google and Amazon have some of those elements. It could be that you've just worked out a way to produce things at extremely low cost. It could be that once someone's decided to take up your services, that the cost to them is so high of switching that they just don't do it. So we've got a framework for assessing whether businesses meet these attributes, and Morningstar assigns what it describes as a moat, a wide moat and a narrow moat, or no moat. So a lot of there are within different industries companies that have that attribute of wide moat who can dominate their industry, maybe even hop across industries. It's more like that than it is particular industries per se that are going to grow rapidly and you can be super sure about. So it tends to be more around the value creation of the business and the things that it does to allow it to continue to grow very quickly at profitable rates of growth.
Okay. That makes sense. Does Morningstar also provide buy prices, or is it just what they think is so Morningstar
has a unit called Morningstar Equity Research, and they produce that research. And so for Morningstar clients, they can access that.
If we move on to the current rebound in the stock market, so the stock market is currently rebounded, right?
Yeah.
Do you think that's sustainable? And what conditions would need to hold for that to continue?
So let's take a step back. So if you think back over the last few years about what's happened and what's caused prices to move around, pretty soon you realize there are things that happen just out of the blue that you may or may not have forecast. So COVID was a good example. I don't think people were really expecting Donald Trump to be reelected. And aside from some Ukrainians, I'm not sure people were expecting Putin to have another go at invading Ukraine. So shocks are a regular feature of life. Uncertainty is a regular feature. And there's that randomness is also combined with complexity. So we happen to live in a very interconnected world where businesses rely upon other businesses all over the place to do certain things for them. So because of that, you're continually faced with uncertainty about things that will happen and will drive prices up or down. So there could be storms or weather that suddenly cause growth to be weaker, or maybe force up the cost of some essential commodity. So because of that, we find that in general, there's not much value to be out of the short-term forecasts because nobody knows, and there's a randomness and complexity that make it really hard to ascertain. What we do instead is build a view from the bottom up, where we say, what's the fair value of everything? Okay, let's compare the prices of everything to what we think the fair value is and other metrics. Are we seeing extremes? Yeah. So we're not seeing extremes at the moment on that. The second thing we look at is, are investors extremely fearful or extremely greedy? Because the way investors behave is going to push prices up and down a lot in the short term. So when they're very greedy, if they've been through a prolonged period of that, then it's more likely that they're more likely to be less greedy in the future because they're really greedy, and therefore that could put downward pressure on prices. In the same way, if everyone's super fearful, only think of the worst, think that's bad, then they might become less fearful. So we look at that. We're not seeing extremes in that either at the moment. And then the third thing is how easy it is for companies to raise capital. When it's very easy and anybody can raise money from anybody else, even with no business plan, they're losing money, but they've got a nice smile, they talk, they've got the chat, fine. Then that's a situation where you should be worried as an investor versus one where even great companies can't even raise essential short-term debt, which is very safe for investors. So we look at all those things. At the moment, we're not seeing anything that is indicating anything extreme going on. Generally, equity markets do move up over time. They track their earnings. At the moment, we've got inflation staying well behaved, interest rates on a downward path. And what everyone's grappling with is, okay, what is the end game with these tariff changes? What will happen? How will it happen? What will the effect be? And as we've seen this year, this US government likes to be provocative. It likes to frame things as if you're in a game show with spectacular presentations and that sort of environment means it's going to be jerky because you're going to continue to have surprises around what they're going to do.
Okay.
So I think you should be expecting a continuation of markets lurching up and down. At the moment, people are assuming the glass is half full and that the net effect of the tariff changes will be pretty modest, which is why markets are back to kind of where they were at the start of the year.
Okay.
The ones that were affected.
Okay. Yeah, because the rebound's been quite big and you can kind of see the optimism with people because it's like this expectation of, okay, everybody's trade deals are happening, the tariff is not going to have a lot of impact. And I think it's like what you're saying is like sometimes as investors, we underestimate things a lot, right? Especially in the short term. It's you really have to just try and play the long game as much as you can and try and not be too much in the weeds if you can. Talking about for those that want to get started and they're thinking about building a well-diversified portfolio, what's the most important things for them to keep in mind, especially one that a portfolio that can kind of again just help them achieve their goals?
Yeah. It's a great question and a really good way to frame it, Addo. Yeah, I really like that framing you've got there because it's about achieving the goal. It's not about I made 100% or I beat the market. It's about did I achieve my goals? Yeah. So there's two things that are helpful here. One is during the course of your working life, we know certain things will happen, which will impact what is a appropriate way for you to invest, given your circumstance. So we know at the start of your career, maybe you're working for 40 years, 50 years. So you're going to have that continual stream of income for a very long time. And so you've got the ability to recover from any setbacks. And that means that you can afford to take risk. If that money is being invested, unless you need the money to fund something in the short term. So clearly, if you're needing to fund something in the short term, you hold cash. If you're needing to fund something in the next 3 or 4 years, maybe there's some fixed income shares. But generally speaking, for longer term things you might be saving up for, it's better to be investing in shares. So that's a simple thing to bear in mind when you're young, that you have the capacity to take risk.
Okay.
Probably. So these are very general statements I'm making. It's not advice to anybody individually. It's just a general statement that there is generally more capacity to take risk when you were younger, because you've got your whole working life ahead of you. You can recover from things. You've got income that will go up over time. Yeah. Whereas if you're at a much later stage in your life and you are getting close to retirement and you're not working anymore, then you're not going to have that future income that you used to have from working. So it's a bit harder to recover from setbacks. And in fact, you're going to be relying on selling your investments to fund your life. So at that point, you have to be a bit more careful about taking risks and take less risk. So that's a simple thing to have in the back of your mind as a general playbook, which has impacts on kind of investment. So when you're young, you can afford to have all of your money in shares, but when you're getting older, you need something else to diversify, because there are times when equities can fall a lot. And if you're selling your investments to fund your life, what you don't want to have to do is sell those investments when they're fallen heavily. So you need some other assets there to help you with that. So that's just a general. Then in terms of individuals, this is really about you knowing what it is that you want. Back to that point I made earlier on. So let's say you decide that your goal is to be able to fund some further education for yourself, and you want to do that in the next 5 years, or that you want to own a vehicle. You've had your eye on this thing, whatever it is. So those are the things you've got to get clear. What are my short-term, medium-term, and longer-term personal goals? What money am I going to need to be able to afford to do those things? And therefore, what have I got now? How much will I need to save? Because that's actually the single most important thing, really. It's saving money so you can invest it. And then the investment strategy will be partly a function of your capacity to take risk, talking about that before, as well as the opportunities you have at a point in time. So short-term is obviously sort of cash-like instruments, intermediate, small bonds, and long-term, small like shares, and then you can get a mix of the three and put that together if you like. And if you're very adventurous and you're very interested in investing and you're prepared to put the time and effort to educate yourself, then you can be get a bit more involved in setting the strategy. I always think that a good book for people to read is Ben Graham's The Intelligent Investor, and he talks about effectively different ways that people can think about what kind of investor they are, how hands-off they want to be. So that's holistically how to do it. For our clients, we run 5 sets of strategies, from what we call cautious through to what we call adventurous, with different amounts of shares and other assets to reflect that risk, and then diversifying that so that we're not overly exposed to a small number of companies or industries, because if you're very exposed to a small number of companies or industries and you're unlucky and they don't work out, then that can have a devastating impact on your wealth. So you need to have some diversification, and that also means diversification in terms of the countries where those businesses earn their revenue. Now, in the UK, as I mentioned, actually when you buy the UK stock market, you're buying the world, because the businesses that you're buying shares in are getting the majority of their revenue outside the UK, because they sell what they do everywhere else. So those are kind of the cornerstones, really. Okay,
thank you. No, that's very, very comprehensive. Really, really happy with that answer. And I wanted to ask this, I have to ask this, because a lot of my audience invest in these funds, S&P 500, global index funds / ETFs. They're very interested in that. And some people invest in one or the other. Some invest in both. What's your take on these strategies? Especially, I think it's termed as like the passive strategy to, building wealth.
Well, it gives you, the advantages are, it gives you this broad diversification. So you are following a simple set of rules, which says I will invest more in a company if it's a bigger company, as measured by the value of its shares. Usually it's partly bigger companies who have got more revenues, the kind of big company names, and you're investing less in smaller companies, and you're automatically changing the weightings based on based on the share price movement. So it'll effectively be a bit like a momentum wave where if a company shares have gone up a lot, it will become a bigger part of your portfolio. So that's what an index fund is. And it has a diversification property. It's usually very low cost. But it does mean that you can end up with quite concentrated portfolios. And so if you follow that index at the moment, then you have a small number of stocks that have a very big impact on the index and an industry. So from that point of view, you also need to sort of make sure that you haven't inadvertently ended up with not enough diversification.
Okay.
But you can get global index funds as well. So I think index funds for beginners are a good start because they're broadly diversified, they're cost effective, they're pretty transparent. So it's a useful tool to have.
Yeah. Especially the global one. The global one's interesting because that's majority US, and that's just because of the returns of it. And then the S&P 500, of course, is just mostly, kind of America. So you think it's a great thing? It's great.
I think it's a useful tool to have for people. So I think there's as a starting point, it's worth looking into.
Okay, that's cool. So what would you do differently if you were starting as an investor today, knowing what you know now?
Yeah, that's a great question. I think I would start earlier investing and I would take more risk.
Okay.
And I'd educate myself about all the things that have happened in the past. So when I think about the future, I'm aware of more scenarios than the ones I just have personally lived through. Because as a young person, your biggest challenge is you know very little, you've experienced very little. But there's a long history of how economies and markets behave, and it's very easy to access that information. So get yourself a yearbook that tells you all what returns have happened over a long period of time, read about the history, also read about who some of the more successful investors are and what they've done. That's what we do to teach our own staff about how to invest.
Okay. Amazing. Thank you so much, Mike. It's been such a fruitful conversation, especially like investing is like one of my favorite part of personal finance. So I always find it like enlightening. I always learn a lot from these kind of conversations. Where can people find you? Obviously, if they, not reach out to you, but they want to see the kind of work that you do at Morningstar.
Sure. I'm on LinkedIn. So that's as good a place as any, for anybody who wants to make contact.
Okay. Amazing. And do you have any final words for watchers and listeners?
Well, I'd say, first of all, you're tuning into the right podcast. Atto's asked some brilliant questions. Okay. So I think there's a very insightful, and I'd encourage everyone to invest in themselves by taking the time to know enough about this and to be prepared to take some risk if they're early on. And so the earlier you start investing, the more you're going to learn and the better an investor you'll be.
Thank you. And I think that's a very good point. I think a lot of people wait too long to start investing and are too cautious because they haven't educated themselves. They haven't taken the time to invest. And by the time that they're comfortable, 10 years have gone by, 15 years have gone by, when actually that their investment could have been compounding much, let me not say much quicker, but had more time to compound, and they maybe would have gotten to their goal a bit quicker as well. So that can happen. So I think, I agree with what you're saying. I think it's really encourage people to start investing, which is why I like to talk a lot about it on the podcast. Thank you so much for featuring on the podcast, Mike. I really appreciate you. Thank you for tuning into this episode of the podcast. See you next week's episode.